Well, good morning, everybody. It's 10 o'clock, so I will call the September 12th, 24 meeting of the Oklahoma City Employee Retirement System to order. Item number 2 on our agenda this morning is to approve the minutes of the meeting of August 8th, 2024. I have a motion and a second. Please record your vote. Item is approved. Item number 3 is a presentation from 2 of our investment managers. Jason, why don't you go ahead and give us a little intro and then we can get started.
Just in keeping with the program of bringing in managers for regular updates, today we have your 2 international managers, Lazard and Harding Loevner. Lazard is a more core value bias manager. Harding Loevner is a more growth bias manager to complement one another. They were just telling me performance has turned around recently. It has been a challenging period for U.S. investors investing in outside of the U.S. really for the last decade on a relative basis to the U.S. But both the managers have done what we would expect in the portfolio. So with that, I'll turn it over to you guys from Lazard.
Thank you, Jason. Good morning, everyone.
Good morning.
My name is Ben Young, as mentioned, with Lazard Asset Management. Appreciate the opportunity to be here and provide an update on our international strategic equity portfolio. I want to first just thank you all for the continued confidence in your investment with us. I think it's been 11 or 12 years, we were saying, so certainly appreciate the partnership over that time. Just very quickly, by way of introduction, I've been with Lazard for 9 years. I'm part of our institutional relationship team at the firm. I'm joined by my colleague, Mike Powers. Mike is a portfolio manager on our international equity platform. Mike has been with Lazard for 34 years, joined the firm in 1990. So I'm going to let him do most of the heavy lifting here as far as walking through the portfolio and kind of what's been going on in the market. But maybe just a comment or two quickly, and then I'll hand it off to Mike, and we can kind of dive right in. On page, a couple high-level comments about the firm here. On page 6, if you don't mind. Just as a quick refresher, if you're not familiar with Lazard, we've been at this for quite a while. History of the firm dates back to 1848. Have over $205 billion in assets under management, and you see in the middle of the page there over 23 offices around the world. But what I want to highlight specifically would be on page 8, if you don't mind. I mentioned $205 billion, but of that $205 billion, you see on the blue bar on the bottom there, over 60% of the assets at our firm we actually manage in global or international equity mandates, so non-U.S. investments and non-U.S. investment strategies. And so all of that is to say basically international investing really is at the core of what we do. We've been doing it for a number of years, have a longstanding experience and history of investing in these local markets, knowing the local economies, and I mentioned those 23 offices around the world. Having the local investment insight combined with the long history, I think really provides a unique advantage and insight for us when managing these international equity portfolios. We're talking about international strategic here today. This is a portfolio, that's the portfolio that you all are invested in with us. This is a strategy with a high-quality management team. I mentioned deep analyst resources really all around the world, and following an investment process and philosophy that we have for since day one to deliver a strong 20-plus year track record. Now, we recognize recent performance has certainly been challenged, and we're here today to kind of walk through a little bit of that and what's been going on with that. We actually included an additional performance page to highlight a little bit of the longer track record that I think Mike will probably reference to hopefully showcase a little bit of how this portfolio has performed in different market environments, and specifically in environments where we've seen elements of what we're seeing in the market here today. And ideally, why we're somewhat optimistic and hopeful for performance moving forward, and we believe we'll be well positioned, and we'll touch on that based on some of the periods where we've seen this in years prior. So with that, Mike, maybe I'll hand it off to you. We can dive right in.
Thanks, Ben. Good morning, everybody.
Good morning.
Just so I get the time target right, I had it in my head about 25 minutes from...
About 20 for the presentation, and then you leave us a couple at the end for Q&A if we have any.
If the prepared stuff we're done in about 20 minutes, that works? Okay, I'll do my best to hit the time mark. So I'll pick it up on page 10, Mary Ellen, thanks. Yep, Just a few sentences on the philosophy process, because that will relate to some of the comments I'm going to make later about the environment. We use a stock picking relative value approach, and stock picking is the principal way you want to add value to the opportunity set, and the relative value is we're looking for good businesses with strong competitive position, good managements that we have a high regard for, and the output of the efforts of the management and the enterprises, if they make a high level of return on capital. I've been, as Ben just said, I've been at the firm 34 years. I never remember us not having a time when we had a premium to broad market return on capital profile. So our return on equity or return on capital, always premium to broad market. We typically, again, on the high quality nature of the portfolio, so premium to return on capital generation, we often are less indebted than broad market, meaning our portfolio companies in aggregate generally carry less indebtedness or less levels of debt, lower levels of debt than broad market. We often grow earnings faster than broad market, and we have an attractive valuation multiple. So again, stock picking, high quality portfolio on those metrics that I just mentioned. And I think that'll, maybe a couple of other specifics. It's an all cap, meaning large size companies, medium sized companies, and even smaller companies. And it's an all world portfolio, but to an EAFE benchmark. Europe, Australia, Far East is a developed market benchmark. So any emerging exposure we have, we currently have, I think, 5 countries in emerging. We'll see that in a minute. And that's an out of benchmark position. And so those need to be high conviction ideas. And happily, just lately, we've been adding value in the emerging space. And so, but it's large, medium, and small company size, and all cap, all world, but benchmark to EAFE, which has no emerging exposure. So we would keep our emerging exposure to a fairly modest level. It's currently about 7%. And again, that's an out of index position. So let's move, unless there's questions, let's move on to the economic market backdrop. And that is page 16, Mary-Ellen, thanks. So here, we've been living now for 4.5 years with a very abnormal 100-year event, which of course was the virus. And with the lockdown, central governments, including our own being the most aggressive about this in terms of what I'm going to say, brought the biggest monetary and fiscal stimulus in history by big amounts. And just to be specific on that, that's to fight off the negative effects of the lockdown and the potential recession or even depression that could have come. During, post-World War II, the Marshall Plan, General Marshall's plan to kind of rebuild Europe after the war, that was about 5% of GDP. What we've been doing for the last, 3+ years has been, depending on who's doing the measuring, 20 to 25% of GDP, enormous numbers. And so huge fiscal stimulus, interest rates engineered by central banks, our own being the most aggressive, took short rates to 0, and then through their bond buying programs took down the yield curve, like at the 10-year level. Those rates got down less than, I think at their lowest were lower than 50 basis points, so close to 0, but not exactly all the way. The most aggressive monetary and fiscal stimulus ever, that brought distortions to markets, and you had times when the most growthy stocks with the highest valuation multiples outperformed. Why would that happen? I would explain that on the interest rate side, because the most growthy stocks by definition are valued on the outer years of earnings, years 3, 5, 7, even 10 projections out. And when you discount that back to present value of share price, the discount rate or the interest rate, the way the math goes, and if you have an actuary here, you would confirm this, as interest rates go lower, the valuation multiples go higher and higher. And so the longer duration assets, like the most growthy stocks, they had moments when they really outperformed. At the other end of the spectrum, again, because of history's lowest interest rates, if you were a maybe more heavily indebted company, maybe junk rated, and money was so cheap and relatively easy to get, if you could and our fixed income people explained it to me this way. If you could call in your more expensive debt, refinance at a lower interest rate, you typically got a credit rating upgrade when that happened. Your stock went up and reflected that. It doesn't mean all of a sudden you're a great, low level of debt company. It just means that you're better than you were. And so you had other, so during the last 4.5 years, and we'll see an exhibit on this in a minute, you had periods when the most growthy stocks did really well, or the deepest value, we would call lower quality, did really well by big margins. We tend to operate more in the middle, and so that's been a tough environment for us. So, again, emphasize this was the last several years was a 100-year event, the virus, and then the aftermath of all that. And if we turn one chart forward, please. Yeah, here's what I was talking about on those style extremes. And this is a 20-year chart. If your eyes are good enough, you could see on the lower left, it's June of 05 is the left-hand time axis, and over on the right, June of 24. And what comes across the page, that wiggly line, the blue line going up and down across the page, when it's rising and getting up high on the chart, that means that growth stocks in the international space, and it's comparing the returns of EFI growth index to the EFI value index. And when it gets way high on the page and to the right of the dotted line, that's the virus time. You can see how in the beginning there, the most growthy stocks had periods of big outperformance. And in terms of how much outperformance, the left-hand numbers, you can see 20 percentage points of outperformance there. And those returns are more than 2 standard deviations above sort of what's the data that's shown there. 2 standard deviations means that 95% of the data falls within that the 2 standard deviation band, and these outcomes became sort of at the extreme ends, maybe the upper 2.5 or the lower 2.5, and then when the line comes down, all the way to the other end of the spectrum, that's when the value stocks are doing the best by big numbers. And again, those tended to be the lower quality, maybe more heavily indebted, more marginally profitable businesses that benefited the most from all that amazing stimulus, that very high level of stimulus that was going on. So I think this is an important chart as we just now turn on for a minute to get into the performance. Any questions, comments so far? Okay. I see I've got about 10 minutes left, maybe 12. So if we go forward to performance, thanks, Mary Ellen. Here's the performance of the account. These are mutual fund returns, and so they're net of all costs. And so you can see the inception, and I was here, I remember standing over there, with my colleague Tony Doty, who was standing over there, I guess just about 11 to 12 years ago, doing the initial new business presentation. And so here's the track record. And you can, if you look at the year by year, 2014, pretty good. I won't go through every year, but the initial years were pretty strong. And then, come 2020, that's the virus. Remember, the virus came kind of in, I think you first started to hear about it in February, but by about April, it starts to be, it actually is going to come all the way here from over in Asia. And so 2020, we managed to do well. And then in 21, 22, 23, over in the lower panel, toward the left, you'll see that we lagged by 500 plus basis points. Again, these are net of all costs. Then it begins to taper down in terms of our lag to the index to 243 and then 118. And so as inflation, which was a ultimate result of all that stimulus, where central bankers wanted to be 2%, it got to be 8 or 10, and so then you had a historically aggressive tightening cycle by central banks. As things are beginning to normalize, meaning inflation is coming down close to 2% recently, and our own central banker, Jay Powell, is saying that it's virtually certain now next week when they meet on I think it's the 17th and 18th next week, they're going to do their first rate cut, since the virus time. And as things are normalizing, we're starting to do better. We outperformed in the fourth quarter of last year. We outperformed in the first quarter. We underperformed in the second quarter, but now so far, third quarter to date, we're outperforming. And so our relative performance, which in the first number of years was strong, and then the virus comes, and those extreme style effects were really adverse for us. We tend to do best in that shaded area on the prior page, and obviously that wasn't the case in terms of environment, and that was very difficult for us. But as that environment is now normalizing, meaning inflation coming to a more normal level, interest rate policy on its way to being more normal, we're starting to do better. And so in the bad time, it was sort of 2 steps backward, 1 step forward. Lately, it's been 2 steps forward, 1 step back. It's not linear like a switch flips and all of a sudden it's great for us. It's sort of in a bottoming process. And as I said, in recent quarters, we're doing much better, including the quarter that we're in. Any questions, comments so far? One other thing has been mentioned on the next page. Thank you, Mary Ellen, page 19. This is the entire track record of the product you're in, the International Strategic Mutual Fund. And I just wanted to show this because it has some precedent environments that, at least for 1 year, were similar to what we're in. So if you go all the way down to the bottom panel, you'll look across, you'll see the year of 2009. Remember, 2008 was the global financial crisis. We had a good relative performance, but then, again, massive stimulus comes, you get recovery, and low quality outperforms for the very same reasons I just explained. Interest rates are very low, you're starting to get some recovery, maybe more heavily indebted, more marginally profitable companies get the most sort of boost from that, and we underperform. But then look what happens as things become more normal. In the years of 2010, 11, 12, 13, we have very strong performance, across the board there. Similarly, in the middle panel there, 2016, that was in 2015. China was really slowing down. A lot of people were saying, are they even going to have a recession? The government came with what's called bazooka-level stimulus. In other words, very strong stimulus, monetary and fiscal, a little bit like what I just described from the virus time. And so again, that was a time when low-quality companies outperformed and we underperformed quite meaningfully. And then, you can see that's followed by 17, 18 good years, and 2020 was a good year. And then again, this extreme environment comes in the years of 21, 22, 23, tough for us, but that you can see that it starts to taper down our lag to the index. And as I said, fourth quarter, first quarter, now third quarter, we're outperforming. And so as the environment is beginning to normalize, we're starting to do better and better. Is that? Okay, thank you. In terms of, if we go forward 1 page, in terms of attribution, just quickly here, this is the year-to-date through June, and happily it's gotten better now so far in the third quarter. But the thing I wanted to point out here is that, for instance, it shows that we lagged in financials, industrials, consumer discretionary, those ones over on the upper right, those are sectors we lagged. Every one of those sectors now in the third quarter we're outperforming. Same thing geographically. Japan, we had a lag, in the first 6 months. Now it's coming like gangbusters so far for us in the third quarter. Similarly, Europe, we had a meaningful underweight. Now this quarter to date, third quarter, we're performing about in line in Europe. And so everything that's been working against us is starting to come good for us, and our performance is nicely picking up. That's the point I wanted to make there. And if we turn forward to page 23, let's try 24. There we go. So here's the portfolio. It's about 60 names, and what's done obviously quite well for us this year, even last year, has been in technology, where obviously we're all hearing about artificial intelligence. NVIDIA doesn't make any chips. They design chips. Who makes them? The logic chips are made by Taiwan Semiconductor. You can see that's in the portfolio there. That's done very well. So this has been our best group in the last calendar year of this year and last year. We have other sort of picks and shovels provider to the, where these are companies that might be Japanese or Dutch or from some other locales that are providing, either chips or they're providing machines that make chips or some of the raw materials that go into, chip making. And so we've very nicely participated there. We also, in the healthcare space, we were very early to understand the implications for both Eli Lilly and Novo Nordisk of these diabetes treatments that also turns out that they are very effective at weight loss. You can lose 15 to 20% of your body weight if you take them, and those things are really, doing well. We also have a couple of exposures there on Gerresheimer and Schott. Those are companies that make the vials and the delivery pens where people can inject themselves with, it looks like a ballpoint pen. And so those have been good stocks for us as well. So we've done quite well in tech, in healthcare, in two sort of topical areas. And then, as I said, really across the portfolio now, even in the third quarter, we're getting good performance out of financials and consumer discretionary and in some of the other areas that were a little bit lagging earlier in the year, they're really coming good for us now. And I would say the same thing if we go forward by country on the next page. Thank you, Mary Ellen. Here you can see, the exposures, places that were lagging for us a little bit, like continental Europe, they're coming good for us now. And so emerging markets, we've been adding value this year. Again, that's an out-of-index position. That's alphabetical. And so you can see Greece is an emerging market that's been doing well for us down at the lower left. In the middle column, Mexico, we've made good money with that stock. In the middle toward the bottom, and then I mentioned Taiwan Semi over on the right, South Korea, Samsung. Taiwan Semi makes the logic chips that go into they're in the NVIDIA branded chips. And then Samsung is one of the two big providers of the memory chips. And so we're very much exposed to that artificial intelligence revolution that's going on. And so, and even in the third quarter, we're starting to get some currency help to the dollar-based returns. After in the 10, 11 years, or the 11 years we've been managing money for you, I would say currency has taken, the ever-strengthening dollar in that time has taken maybe 2 to 2.5 percentage points of dollar-based return away. And the dollar today is maybe 15 to 20% expensive relative to fair value, so our global fixed income people tell me. And with interest rate policy on its way to normalizing, the U.S. has higher inflation, higher interest rates, both short and long, than the UK, Europe, Japan, and it's widely expected that with higher inflation here and higher interest rates here, the U.S. is going to have a steeper rate-cutting cycle, and those other countries or locales that I just mentioned are going to have a shallower rate-cutting cycle. That's probably dollar negative, those other currency positive. That's what's happening so far in the third quarter. And so, and this portfolio, by the way, is outperforming the S&P third quarter to date. So anyway, that's, I want to pay it, I've got about a minute or two left, and so I know there's time for questions.
You have a hard copy of this presentation?
Forgive me.
You have a hard copy of this presentation?
I have one hard copy. I'm certainly happy to send out some as well, actually.
Yes, I would.
Any other questions? Okay. Thank you, gentlemen, very much.
Very much.
Very much, thank you. Okay, next up is Harding Loevner. Good morning.
Good morning, everyone. Thank you for having us today. It's great to be here in Oklahoma City. I'm Dylan Strober. If I look familiar, it's because I was at your conference last year that you graciously hosted. I'll be in Tulsa in a couple of weeks if those of you are going. Happy to connect there as well. I'm joined by Hannah Hastings. Hannah's a portfolio specialist at the firm. She's been with us since 2013. I'm the deputy manager of our firm's institutional client team responsible for the Oklahoma City relationship. We have 20 to 25 minutes. We'll be sure to leave time for questions, but we're planning on just doing a refresher on who we are, update on the firm, and then get into performance outlook and positioning. We want this to be the best use of your time, so please feel free to interrupt with any questions as we're going through. Mary Ellen, if we could start on page 2. Quick snapshot of the firm. We've had a single philosophy and belief since the foundation of our firm in 1989, and that's that, to find the best companies, we have to look across borders globally to find the highest quality, fastest growing companies in the universe. We have one single office in Bridgewater, New Jersey, 121 employees, and that single philosophy and process driving our investment styles across our strategies. If we turn to the next page, you see our family of strategies there. The international equity strategy that you're invested in is at the center of the page. It's our flagship strategy. It's been in existence since 1989, the founding of our firm, and it accounts for over half of our $50 billion in assets. If we move on to the team, you see what we call our yearbook page here, a diverse group of company analysts, primarily devised by sector. Our analysts are tasked with finding the best industries within their sector and then the best companies within their industry. Uniquely, they're not directed by the portfolio managers to cover a certain company. We benchmark them to their own sector index. They have full autonomy. They're the kings and queens of the process. They're also not incentivized to get their companies into the portfolio. We want research analysts. We don't want salesmen. So we do not incentivize them to sell their stocks into the portfolio for our clients. You see our portfolio management team on the right-hand side. 4 individuals, 2 co-lead managers, Farrell Roll and Andrew West. Farrell's been managing this portfolio since 2011, Andrew since 2019. If we turn to the next page, you'll see our unique portfolio management team structure. So we have these co-lead portfolio managers. They're each running their individual sleeves. We staple those together 50-50 to form the client model that you're invested in. So it's diverse opinions. Andrew and Farrell can agree or disagree. We believe in collaboration without consensus. We want the portfolio managers to work together, but we believe in disagreement fostering the best ideas. They're supported by 2 individuals called paper portfolio managers. They're also running their individual sleeve of stock picks, but there's no client capital allocated to their sleeves. The reason for that is for training purposes. Patrick and Uday are both senior analysts that we've tasked with portfolio management responsibilities. We want them to train and learn how to manage a portfolio without your capital allocated to it. The second reason is for succession planning. In the event of a retirement, in the event of an emergency, we want someone with a proven track record to come in and fill the space of a co-lead manager. We've replaced a co-lead manager for retirement purposes. We've also, unfortunately, had to replace a co-lead manager for illness on a different strategy. That this process has worked for us in the past. The third reason, and probably most impactful to your portfolio in the short term, is signaling. Patrick and Uday are compensated on their portfolios as well. Their decisions are transparent to Farrell and Andrew, and so when they make a purchase or a sale, it's a signal to Farrell and Andrew to maybe take a deeper dive at one of the companies and the decision making there. Any questions on the firm, our philosophy process, the team at all? Great, so I'll move on to performance before I pass things over to Hannah on page 6. You see performance of our international equity strategy through June at the top, through August at the bottom. So it's been a difficult stretch of time here for Harding Loevner, particularly a difficult first quarter of 2024 and a difficult third quarter of 2023. And that's dragging on the 3- and 5-year returns. Our 10-year return is still positive. We appreciate your 12 years of investing with us. As of August, the mutual fund that you're invested in up 7.9% versus the index up 6.8%. So still some excess returns in the trailing periods, but what we've delivered in the recent period is not what we endeavored to deliver for your retirees. We're going to talk about why we've seen some underperformance and what we're looking at going forward. I'll note that if you look at the bottom chart through August, it's been a better quarter for us, some market leadership revision, and we've outperformed in the month of August by about 120 basis points. With that, I'll pass things over to Hannah.
Hello, everyone. Good morning. If you flip to the next page, please, Mary Ellen, you'll see what we've done here is split the index our benchmark being the MSCI ACWI ex-US index. So I think actually a worthwhile distinguishing feature in that, while the Lazard portfolio has a zero benchmark exposure to emerging markets, we do have emerging markets within our index, and you'll find shortly that it's actually a sizable part of our portfolio. But what we've done here is split the index into quintile of quality, of growth, and of value rank. And these are proprietary metrics that we've come up with over the years, but it helps sort of paint a picture of what's going on in the market from a style perspective. As quality growth managers, we tend to do well when quality and growth are outperforming. We tend to underperform when quality and growth isn't in our favor, and this helps sort of set the stage for style, if you will. What you see here is that quality and growth actually did outperform in the second quarter of this year and have done not that poorly over the trailing 12 months. I will say there's a bit of an index concentration effect here. I'm sure you've all read headlines about how NVIDIA is becoming an increasingly large part of the US index and really driver of returns to the S&P and other US-based indices. We're seeing a little bit of a similar effect internationally, where the likes of TSMC, of Tencent, of Novo Nordisk becoming an increasing part of the benchmark. Now, we have exposure to those companies too, I should say, but if you strip those out, the outperformance that you see here from the highest quality, fastest growing companies essentially is erased, in fact, slightly flat. Mike already did a really nice job outlining what's been going on in the market, so I won't belabor that on the next page, where you see the benchmark performance by sector and by region, other than to note that there's been a good deal of divergence. We've seen really strong performance from the likes of information technology, which has been driven, much like what we've seen here in the US, by enthusiasm around the prospects of generative AI. Other corners of the market, consumer discretionary, notably much weaker, as we've seen a slowdown of EV sales, the auto industry, of course, being a sizable part of the consumer discretionary sector. By region, I'd call out Japan, in fact, which has been on quite a tear for much of the last year and a half, although less so in the second quarter of this year. We'll get to it in a minute, but Japan's actually been a sizable part of the strategy's underperformance over the last year and a half, in part due to some significant style headwinds that we've been experiencing there. So, that's really setting the stage in terms of benchmark performance. If we look at the portfolio's attribution on the next page, thanks, you're beating me to it, over the trailing year, what we've done here is break out attribution by sector and by region, whereby the red bars represent the stock selection effect, the gray bars, the sector allocation effect, so the degree to which our over or underweight to any particular sector or geography helped or hurt, and then, of course, the total effect, the combined of the two. Now, Harding Loevner is a bottom-up stock picker. We live and die by stock picking, and you see here that was indeed the case over the trailing year, unfortunately for the negative. Nevertheless, the red bars really dominating both of those pictures. When I look at this, two things really stick out to me. First is the underperformance within healthcare. Some of that's been what's in the portfolio, namely Sysmex, a Japanese hematology company that has struggled with growth in China, as China has put forward more and more sort of made in China regulations that prevent growth for Sysmex. But we've also seen weak returns from Genmab, a Danish manufacturer of cancer drugs, specifically Darzalex, multiple myeloma treatment, on concerns of potential loss for additional royalties from its partnership with Johnson & Johnson. A big part of this, though, and you see, in fact, the second largest detractor from relative returns over the past year has been the absence of Novo Nordisk. I'll hand it to Mike for having it in his portfolio. We cover Novo Nordisk. We've had it in the portfolio for a number of years, sold it most recently in 2016. It meets our criteria for both quality and growth, but we've struggled with the price, and we've become increasingly concerned around the growth thesis. So happy to talk to that a little bit more, but you should know that while you have Novo exposure in one of your international managers, you don't in another, and that's hurt at least our portfolio. It's not all bad news, though. Like your other international portfolio, we have a sizable exposure to TSMC, meaningfully overweight. It's been a top contributor, as Mike mentioned. NVIDIA relies on TSMCs for the production of its GPUs, and it's done quite well over the course of the past year. A few things on the mind of our portfolio managers that I thought I'd relay today. First of all, relate to elections, right? You'll see on the next page that 2024 is a banner year for democracies globally. I think there's expected to be something to the tune of 50 elections happening over the course of this year. The grand finale, of course, coming up here in just a couple months. Now, we're bottom-up stock pickers. At the end of the day, we're looking to invest in high-quality, long-duration growth companies that are going to be able to weather any uncertainty, whether that's related to an election cycle, whether that's related to geopolitical uncertainties or interest rate uncertainty. However, you don't go outside without checking the weather first, right? And that's the same approach that our portfolio managers have taken. We want to be really mindful of these risks, and we've been kicking the tires of the portfolio, if you will, over the course of much of the last year, in particular coming into the third quarter as we approach the election here in the US, making sure that our not small revenue exposure at around 20% to the US is positioned in sectors that are not likely to come under scrutiny from either party as tariff and trade-related restrictions come into the conversation. Now, I do just want to spend a minute on Novo Nordisk, because if I didn't, you might ask why. In fact, we haven't held it. You see on the next page here that Novo has been up a whopping 82% over the course of the trailing year ending June 30th. If you take Novo out of the healthcare index, it's basically flat. The index up 1.2%, ACWI ex-US healthcare. So this is indisputably a miss on Harding Loevner's part, right? If we could rewind the clock, if we had, like Mike, appreciated the prospects for Novo's Ozempic and Wegovy drugs, the potential for the GLP weight loss trend, I think we would have bought in. That said, we're not going to chase our tails. We're not going to chase the crowd. At the multiples that the stock is affording now, it seems a little too expensive to us. We also have some concerns, frankly, around the long-term potential for Novo as more and more candidates enter phase 2 trials around these clinical weight loss drugs. Now, just because we don't have exposure to Novo doesn't mean that we don't have exposure to this GLP-1 theme, if you will. Chugai Pharmaceutical and Roche Pharmaceutical, the latter being in Switzerland, the former in Japan, have both been very strong contributors to returns over the course of the past year, and actually over the third quarter to date as well. Both of them embarking on their own GLP-1 journey, if you will. Chugai Pharmaceutical, we actually like it for its hemophilia drug, Hemlibra, but the company has been in partnership with Eli Lilly on an ingestible, so a pill version of a GLP-1. In the absence of Novo, we have filled our healthcare exposure with a number of really interesting businesses across what I would call really 3 different buckets, and you'll see those on the next page here. The first being related to oncology. When we look globally, oncology-related spending is expected to double over the 6 years between 2022 and 2028. We have a number of portfolio holdings there poised to benefit from that, but also companies that have very steady revenue streams and stable patterns of returns. It's a nice foil, if you will, for the portfolio from the more volatile corners like the semiconductor industry. And then finally, companies benefiting from globally aging populations. It's not just here. It's not just in Japan, where the world's getting older, it's globally. And companies like Alcon, a leader in macular degeneration, all things eye care, Sonovo, hearing aids, even Coloplast, a recent purchase in the portfolio, poised to benefit from an aging global population. If you flip to page 14, please, Mary Ellen, thanks very much. You'll see our transactions over the course of the last year. A few things I'd call out here. First of all is the low turnover. Portfolio turnover for the strategy remains quite low at sub 15%. That's something you should, generally come to expect from Harding Loevner. We're long-term in nature. We want to be shareholders for 5, 6, 7, 8 years, and that's reflected in the low portfolio turnover. That said, we're happy to make changes where, we see changes as needed, and you see that we've purchased or sold a handful of companies each quarter. What sticks out to me is that we've really shifted our exposure to both China and Japan over the course of the last year. In the case of Japan, letting go of some companies that were failing to meet our internal mileposts around growth. Also companies particularly exposed to a weaker yen, like Nitori, which is a Japanese IKEA, if you will, of furniture. In China, we've really moved to focus more on companies poised to benefit from possible future growth domestically, and companies that are not involved in selling extensively into the US. Companies like ZTO Express, which we purchased in the first quarter. It is the leading parcel delivery company in China. I always like to throw these numbers out. In 2023, UPS shipped, I think it was 5.6 billion packages in the US. ZTO shipped 30 billion, so it's on a completely different scale, right? We like ZTO because it has no aspirations for growth here in the US. It's not likely to be caught up in trade-related tensions, regardless of the election outcome. I'll leave you with page 15, which is our portfolio positioning at the end of the quarter, and something that hasn't really changed much over the course of the last 2 months. We have material overweights to sectors like consumer staples and healthcare, where we've found a number of steady, consistent growers in the portfolio. Company I always like to point to is Haleon. It's a UK-based consumer health products company, makes everything from Excedrin to Tums to Sensodyne. It's a type of business that's never going to be hitting home runs in a single quarter, but delivering that very high quality, stable pattern of performance that we look for. It's also the type of company that, if we are to move into a recession, we think will be poised well. You need your Tums all the more if you move into a recessionary environment. By region, I just want to call out our underweight, though still meaningful, exposure to emerging markets at fully a quarter of the portfolio. When it comes to emerging markets, I think diversification really is the name of the game, making sure that we haven't put all of our eggs into a single basket, right? So when I break that 25% down, 8%, so about a third, is split across the 2 largest holdings in the portfolio, Taiwan Semiconductor, which we've already discussed, but also Samsung Electronics. Both of those are companies very much so interwoven within the global supply chain and developed market consumer. Another 8% is invested in China, where we're essentially benchmark neutral. I think diversification even more important in China, where we've been very careful to diversify our exposure. We have 8 holdings representing that 8%. That's across 7 different sectors. Again, being really mindful of the risks associated with investing in a market like China. And then the remaining 8% really sprinkled throughout Latin America, throughout India, and even smaller markets like Indonesia. I know I said I'd leave it here, but maybe I'll just flip to page 16, where we have one final chart, and I think this helps put sort of our pattern of performance into a helpful context. As you think about where the world is going, where markets are going, I think this is a useful tool to look back upon. It shows that each of these red dots represent a 5-year period of relative performance for the portfolio since our inception in 1989, so about 35 years. If the red circle falls in the gray area, it means we've underperformed over that 5-year period. If it falls in the white, it means we've outperformed. What you see here is that, in periods where markets are ripping, when over a 5-year period, the market has returned over 10% annualized, it's a bit of a jump off for us. Those are the sorts of markets where fundamentals are kind of thrown out the window, and it's a more momentum-driven environment. We outperform a little less than 60% of the time. But in periods where markets are falling, or in very low single digits, we've managed to deliver very strong relative performance during that period. So, I have no idea where markets are going over the next year. My crystal ball is as cloudy as anyone else's, but, I am comforted by this slide. And as we move into, a period of perhaps increased volatility, we've seen rates go down in Europe this morning, likely to follow in the US. I think solid protection on the downside, focus on quality, focus on growth. should put the portfolio in a good position.
Okay. Does anyone have any questions this morning? Okay. Well, thank you very much. Enjoyed it.
Thank you.
Okay. We are now on item 4, the consent docket. We can take all those items with one motion. I have a motion and a second. Please record your vote. Item is approved. Item 5 is to ratify approvals. Item 5A, no, I'm sorry. We can do these with one motion. We have a motion and a second. Please record your vote. Item is approved. Okay. Item 6 is to approve the claims docket. I have a motion and a second. Please record your vote. Item is approved. Item 7 is to approve the following applications for service retirement. We have a motion and a second. Please record your vote. Item is approved. Item 8 is to approve continuation of pension to spouse. We have a motion and a second. Please record your vote. Item is approved. Item 9, receive report of death, authorize payment of the $5,000 death benefit, and approve continuation of pension to spouse. We have a motion and a second. Please record your vote. Item is approved. Item 10, receive report of death, authorize payment of the death benefit, and authorize secretary to make necessary changes to conform on the following. We have a motion and a second. Please record your vote. Everybody vote. Item is approved. Item 11, receive report of death, authorize secretary to make necessary changes to conform on the following. We have a motion and a second. Please record your vote. Item is approved. Item 12, approve the following application of vested rights. A motion and a second. Please record your vote. Item is approved. And item 13 is approve the following applications for disability retirement. Have a motion and a second. Please record your vote. Item is approved. Item 14, we have items for individual consideration. Item 14A is amendment number 1 to the agreement between the OCERS and the city regarding the city's obligation to provide certain professional, non-professional services, and of course, office rental to the ERS for the retirement system to provide certain professional services for the city, effective October 1, 2024. We have a motion and a second. Please record your vote. Item is approved. Item 14B is a resolution adopting all policies and procedures of the city as they exist currently or as they may be amended regarding accounting and expenditures of public funds, except policies and procedures, etc. This is simply the ERS office adopting the city purchasing policies. I have a motion and a second. Please record your vote. Item is approved. Item 14C is the Administrative Services Agreement with the Central Oklahoma Transportation and Parking Authority to provide administration of 457 deferred compensation plans. I have a motion and a second. Please record your vote. Item is approved. And finally, we are on item 15. We receive the investment consultant report.
Mr. Chairman, may I ask some questions about Lazard?
Yes, sir.
A couple of questions about Lazard. They started off talking about global equities, but to be clear, we're in their international strategic, correct?
Yes.
Okay. Does it concern you that they've pretty consistently underperformed in 1, 3, 5, and 10-year time frame versus the index by quite a bit?
Well, it's always concerning when a manager's underperforming. We try to understand what's causing it, and I think what you saw in terms of the degree of growth outperformance following COVID, and then at the end of last year, the degree of deep value underperformance has really impacted more core-like managers pretty significantly. We see it as well with Allspring, your emerging market manager. If we look at right now, their relative performance, much like Lazard at the end of June, was pretty far behind, and it's because they underperformed when growth was really performing well, and then they underperformed when value was really performing well. If we look at it now, Randy, they've through the end of February, their performance, they've made up quite a bit in a more normal, in this environment where rate expectations are coming down. You don't have to go there just yet, but so their performance now on a one-year basis, gross of fees is up 17.6% versus the benchmark 19.4. So a little bit behind, but they've come back quite a bit. It's been certainly been a unique period. The slide that Mike Powers showed with that 2 standard deviations or performance on the growth side and then 2 standard deviations on the value side, to us, that's really been a challenge for more core-like managers. So we have concerns, but we understand, and unless we're going to switch to have more a change to them to try to get a deeper value manager would also necessitate a change to a more momentum growth manager. We've constructed the international portfolio with 2 managers that are, or really 3 managers, including Allspring, that are more core-like. Harding Loevner with a bit of a GARP growth at a reasonable price, and Lazard with a bit of a value bias, and Allspring is more core as well. So the construction of the non-US portfolio has led to this kind of getting whipsawed over the last few years, but we're watching it closely. We don't have concerns about the team or the organization or that they're doing something different than they've done historically.
Thank you.
Thank you, Mary Ellen. So as we look at this, and one of the things I'll point out, and this is the month of, just in the left side of this page, we have relative returns of broad indices. And for the first time in a while, you'll see that EAFE, or non-US equity, international developed markets, for the month, the best performing market, up 3.3% in the month of August, outperforming large cap U.S. equity, EM, bonds, treasuries, and small cap being the worst performing asset class. On a one-year basis, pretty similar story. I will bring you forward, because I just jotted this down. I always try to bring us up to date of where we are today. This isn't on this page, but we produce a daily index review of where the markets are on a year-to-date, 1 year, different time periods. Through yesterday, on a trailing 1 year basis, the worst performing broad asset class is up 10%. So just think of that in terms of you're needing a 7.5 or 7% return. As we come toward the end of June, I know your fiscal year is calendar year, but on a trailing 1 year basis, bonds, or the Bloomberg aggregate, is up 10.16%, and that's the worst performing broad asset class. Large cap equities are up 25%. International is up just under 16%. EM is up 11%. Small cap is up 15.1%. So pretty robust absolute returns. You're starting to see in the last month and a half non-U.S. performing a little bit better. You did get some outperformance from both your non-U.S. managers in the month of August, as well as Brandywine on the global bond side. That's been a pretty lumpy return due to currency and a little bit longer duration. As rates have come down on the intermediate to longer end of the curve, rate and quarter to date, the 10-year is down almost 75 basis points through yesterday. It's at 3.65% today, which is leading to those 10% bond returns, but that's also led to some outperformance by global bonds and your Brandywine strategy. On a 1 year basis, the 10-year is down 63 basis points. On a 10-year basis, just to put this all in perspective, the last 10 years, the yield on the 10-year has moved up 1%, basically, or 1% higher than we were 10 years ago. Fed funds has not moved. There were a lot of talk and expectations that inflation is cooling. Unemployment seems to be okay, although it's ticked up slightly. Certainly the expectations for a rate cut, as indicated by this chart on the lower right, much higher in August than they were in June or July. A 50 basis point cut, there's a 30% probability. More likely a 25 basis point cut is what's expected in the meeting next week at the September meeting. And that's really buoyed markets. We did see the 2-year and 10-year yield, which had been inverted for a couple of years now, where a 2-year was yielding more than a 10-year bond. That inversion has gone away, and the 2-year is a little bit below the 10-year today. If we look at the next page, in terms of asset allocation, we continue to be slightly overweight to equities. As long-short equity we're redeeming from, we got a significant distribution back in the month of August, and we expect to get the balance back over the next couple of quarters. I will note, and I know, Randy, you had asked about this last month, and we were looking to see where we were going to be in cash. We will do some rebalancing between U.S. and non-U.S., and I'll work with Matt on that after the meeting, but we would anticipate that the target for international developed equity is 15%. It actually increased from 10 to 15 at the beginning of this year, but because U.S. has outperformed non-U.S. by such a large margin, that's kept that from moving up a bit, but we will do some rebalancing between large cap and non-U.S. Fixed income is slightly underweight, but we're holding a little bit more in cash today, so a lot of that cash that came back from the K2 redemptions, we're just holding in cash for capital calls and operating expenses. That's about a little more than a quarter's worth of operating expenses, and we're still getting about a 5% yield on on cash, so we're not uncomfortable with that at this time. Rolling forward to your portfolio, as I mentioned, one-year results, and this is through the end of August, very strong on an absolute basis, up over 12% net, trailing the policy index. Most of that continues to be private equity. Private equity up 6.8%. We're comparing that 10% of your portfolio to the S&P 500. So in the short term, that's been a big headwind. Longer term, you see your private equity over the last 10 years is up over almost 14.5% versus the S&P at 13%. So it's done its job. Really, the relative returns within small cap, non-U.S., emerging, you heard a lot of that discussion today. A couple things, both in the Harding Loevner portfolio, growth portfolio, and Silvercrest. One of the biggest challenge has been these GLP drugs, having an underweight there, and both having a market or slightly overweight to healthcare, but more in devices, which took a hit as a lot of surgeries weren't being done, the more expectations for growth of these GLP-1 drugs that really buoying Novo Nordisk and some of the other names in that space, which the concentration in those indices. But if we look on an absolute basis, still strong returns from both small cap and international. Touched on the individual managers a moment ago. Fixed income, through the end of August, your fixed income portfolio is up almost a little under 7.75%, ahead of the index. As we roll forward a half a month, it's even more positive. Real assets, worst performing asset class on an absolute basis, best performing asset class in your portfolio on a relative basis. The Morgan Stanley Prime Property Fund and some of the private other closed-end private real estate that you have in this portfolio, down about 3.6%, starting to stabilize. We're not seeing declines in real estate like we were. The write-downs really starting to moderate, and actually seeing some transaction activity in that space. But your portfolio has done a nice job of protecting in a much more challenging market. We've touched on why the Morgan Stanley Prime Property Fund, certainly much more exposure to multifamily and industrial than some of their peers, a lot less exposure to office, which has been a positive. If we go to the next page, one more page, on the fixed income side, within fixed income, we talked, portfolio has done well. Really, the portfolio is structured to have a 25% target overall to fixed income. We framed that at the beginning of the year, 15% in what we called multi-sector is how we framed it, but that would be your Core Plus, WAMCO, and Brandywine. So that's really 10 and 5 in these non-core, and then 5% in the unconstrained or absolute return, which is PGIM. PAMCO you see on there, PAMCO is in liquidation. That's a very small piece. It represents 13 basis points of exposure overall. All of the managers are performing in line with expectations. You see that big return from Brandywine in a month where rates came down. They have longer duration as a non-U.S. bond manager, and the currency, non-U.S. currency exposure helped. With Western, there is some news around Western that we need to share with you that raises some concerns for us. So they've had quite a bit of turnover in some senior professionals, culminating in most recently the co-CIO, Ken Leach, being put on leave as a result of, an SEC investigation into trade allocations. So earlier this summer, John Bellows, who was the head of the broad markets team, retired. He was replaced by Mark Lindblom, who is close to retirement, head of their emerging market debt strategy, which is a component of your Core Plus team, left the firm in July after taking a leave of absence. So there's a couple of things there. And then the most recent, on August 21st, it was announced that Ken Leach was put on leave. I met with the co-CIO, Mike Sullivan, of the WAMCO strategy last week in our office, along with our fixed income analyst, to try to understand what was going on. So basically, WAMCO identified an issue in October of 23 related to trade allocations. And what that means, there's a number, WAMCO is managing a number of fixed income strategies and accounts. They purchase, the portfolio managers are doing the trading themselves. They're making purchases throughout the day. At the end of the day, those purchases or trades are allocated to different portfolios. There was some questions about the portfolios Ken Leach was managing as to how trades were being allocated to the flagship strategy and another strategy that WAMCO identified as unusual. They hired a third-party firm to do an investigation, and then somehow the SEC became aware and started doing their own investigation. A Wells notice, which is basically a notification from the SEC that a potential enforcement action is coming, was received by Ken Leach individually in July, and that's when they put him on administrative leave. The Western has not received a Wells notice. The firm is not under investigation, but potentially there's going to be some issues there. It's our expectation he won't be coming back. He's 71 years old. We pressed them on what the impact was from these trade allocations. Their own internal or third-party investigation that they hired auditors and a law firm to come in and evaluate this determined that at least 75% of the trades that were made they would have allocated them the way they were allocated, and there was no issue with them. We have confirmed that none of these trades were related to your separate account. Doesn't have anything to do with your portfolio. All that said, there's a lot of noise here going on with an investigation and with several senior people on the team leaving that we think it warrants looking at other candidates. And so next month, we will come back to you with some recommendations on potential changes to the portfolio and replacements for Western.
Okay. Anyone have any questions this morning?
I just have one question, not on Western Asset, but on PAMCO. You mentioned that being liquidated, or is that what you said, or?
You've been in you put in for a full redemption probably 2.5 years ago. This was a hedge fund of funds, and so there are some illiquid investments in that's left in that portfolio. That's why there's a small value, a little over $1 million.
Right, and I was just looking at the one-year return was just like 90, I didn't know if that's because it's being cleared up.
There's like 2 or 3 positions, and then I think it's True Religion Jeans is one of those positions, and they had it might be worth $200,000 in the portfolio. It was now worth $600. It was marked up significantly. So it has really because it's so small, that's not having an impact on total fund performance. We should probably not show that and just show it as liquidating funds, and it rolls up into performance, but that's what it is.
Anyone else? Okay. Jason, thank you,
Thank you.
as always. Chair will entertain a motion to receive the monthly investment report. I have a motion and a second. Please record your vote. Item is approved. Item 16 is comments from board, staff, and citizens. Look forward to seeing those of you that will be attending in a couple weeks up in Tulsa for our trustee education conference. Let you know Mike's already making excuses about his golf game, so I'll be sure to report back on that next month. So we are adjourned at 11:10.